The S&P 500 is sitting on a 25% gain this year, but with investors chasing the record rally in stocks, is now the time to broaden your portfolio exposure. Let's ask Elizabeth Burton, client investment strategist at Goldman Sachs Asset Management, back with us at Post 9. It's good to see you.
Good to see you.
I'll just ask you on the broad market, just because we just had this story about, a deal that is not going to happen. One of the expectations about the new year is that a lot of deals are going to happen, and that's part of the optimism, along with tax cuts and deregulation and everything else. You want to just give us a sort of broad thought on where you think 25 is going to look like?
Sure. So optimism is always great, and we've seen quite a bit of it over the last month. I think the last 4 weeks ending Friday was one of the biggest monthly flows on record, 140 billion into equities that we've seen. So there's clearly a lot of optimism going forward. We think, as you know, our outlook for 2025 at Goldman Sachs is still positive equity returns, but there's a lot of tail risks. There's a lot of places where there can be some stumbles, and we're so concentrated right now, at least in the equity market, and so few names. It's not going to be shocking to say that we think you should be broadening out, thinking about diversifying your portfolio now.
I mean, it's interesting because that trade had obviously been working quite well until recently, it feels like. Then the money's been finding a home again in a lot of the mega cap names at the expense of broader parts of the market. Is this just a blip preparing for the end of the year, into the new year? What do you read on that?
I think there is something about going into the end of the year. The last 2 weeks of December, the first 2 weeks of January historically tend to be really good for stocks, and a lot of these flows are passive, right? Which means for every dollar you see going into the S&P, 37 cents of that is going into the mega cap names. But we are more constructive actually on the mid cap and small cap names looking into next year. We think there's a lot of room for growth there. There's a lot of quality in the mid cap names. We've said before that we think small cap remains interesting, and we think that story still remains true. And I hear a lot of people saying, it may not be as cheap as you think, but if you look at on a median PE ratio, small caps and Russell 2000 is what I'm talking about, median, you take out the ones that aren't profitable, it's actually trading at a 23% discount, which on historical average is about a 2% discount.
Do you think there's skepticism in part because we've dialed back our expectations of rate cuts, and you need a bunch of rate cuts to make small caps work even better?
That could be part of the issue. I think it's hard just to miss out on FOMO, right? Because if you don't stay invested there, you might think you're getting it wrong. And look, staying invested in growth is part of our outlook, and we certainly like the Mag 7 in addition to the other names. But the Mag 7 we project are only going to outperform the remaining 493 by 7 percentage points next year. That's a pretty small margin to have so much confidence.
You say that next year is going to be about growth assets and diversifiers. What does that mean? When you think diversifiers, what is our viewers supposed to think?
Sure. So I'm saying it's not equities versus bonds. It's growth, which some attribute to equity, but it's a lot of other things too, versus diversifying. So in terms of diversifiers, that could be things like infrastructure, which are, maybe have a 0.6 correlation to equities, but it could also be tail hedges, risk-off strategies, and in this environment, gold and bonds. I think the bond story, while we're constructive on bonds, it's actually one of the biggest changes to our asset allocation is that we're now overweight bonds. It's really in its relative role as a diversifier to your portfolio, not necessarily, a total return story, because we think it's going to be carry driven next year.
So are you thinking a lot about alternatives as part of, and the sort of rebuilding of portfolios in a new political/economic environment?
I don't know if it's so much politically oriented, but rebuilding the alternatives portfolios based on, one, the tail risks you think are coming, and two, what's sort of happened in the private equity and venture markets over the last year. Investors aren't getting their money back. Venture has clearly had some issues, getting funding and returning capital to investors. We think growth equity, for that reason, should be pretty interesting next year. Those sort of check sizes are going to have to come from growth equities. And when you think about that opportunity, there's about 750 unicorns right now, and that's about a 10-year backlog. So those companies are going to need private capital for longer.
They're going to need private capital, which means that at least the IPO pipeline, which is fairly rich,
sure.
A lot of companies are just staying private longer, and they're using the capital that they can get from private equity to stay private longer. Is that likely to change? or no?
Once there's more certainty in the market, we hope that that will change. But, we've been saying that for a couple years now, so we need to see additional certainty. And I think one of the things about 2025, there's a lot of different ways things can go, but we should see a pickup in the IPO market for sure.
I think people are looking internationally too and trying to figure out what possible tariffs are going to mean on different parts of the country. I've had a lot of people who've loved India over the last 2 years. And now, maybe they still do, and maybe they like it even more because China is still hard to gauge on what's going to happen. How do you see India as an investment?
If we take India back to what we were just talking about, the IPO market, India has actually seen quite a bit of IPOs. Since 2015, it's had about 1,000. And we really like the small and mid-cap space in general, and including in India. And small and mid-cap is where we tend to see those sorts of transactions. So we think there's still a lot of tailwinds for India. We think it's a good investment. It's got low diversification to the U.S., low diversification globally, and we have seen a ton of investor interest there. Yep. We actually just took some investors there we joined some investors there for a trip. So there's definitely renewed interest in investing ex-U.S.
All right, it's good to catch up with you. Thanks for being here.
Thanks for having me.
Elizabeth Burton of Goldman Sachs.